2018 started with a bang. MSCI's Global Stock Market Index had its best January since 1994, delivering an unprecedented 15th consecutive positive monthly return. Half of large US corporates in the S&P 500 index reported earnings during January, and a weak dollar and improving global growth was enough to drive fourth quarter earnings for those companies up 12%. Guidance from those companies on the impact of US tax cuts was also welcomed by markets as analysts upgraded their earnings forecasts for 2018, with S&P companies now expected to earn 26% more than last year. Emerging markets also picked up where they left off in 2017. Brazilian, Russian, and Chinese stock markets all experienced double-digit US dollar returns in January. Chinese banks were a key driver of returns as ICBC, the world's largest bank, saw its share price get above its pre-financial crisis highs and up almost 100% since its 2016 lows. Bonds had their worst month since the 2016 election of Donald Trump, with US 10-year bond yields back up to levels last seen in 2014. On expectations that improving global growth will finally bring back inflationary pressure and higher central bank rates. Despite the US interest rates rising faster than their global peers, the euro continued to appreciate against the US dollar, with European economic growth expected to accelerate faster than US growth off a lower base. In the US, sectors with the higher dividend yields like real estate and consumer staples companies were dragged down by the sell-off in bonds. Banks, which tend to benefit from higher interest rates, were among the best performing stocks, along with consumer discretionary companies who are expected to benefit as wage growth and lower tax rates boost US consumer spending. If you have any questions on this or to invest with Anchor, please contact us on sales@anchorcapital.coza or visit our website www.anchorcapital.coza.